Bitcoin halving is one of the most important events in the world of cryptocurrency, especially for Bitcoin. It happens roughly every 4 years, and each time it brings a mix of excitement, speculation, and a lot of media coverage. But what exactly is Bitcoin halving? Why does it matter? And how does it affect the price of Bitcoin, the miners, and the entire network? That's what we're going to break down in this video. To understand halving, we first need to understand how Bitcoin works at a basic level. Bitcoin is a decentralized digital currency that operates on a network called the blockchain. Every transaction that happens on the Bitcoin network is verified and recorded on this blockchain, which is essentially a public ledger. But how are these transactions verified? That's where miners come in. Miners use powerful computers to solve complex mathematical problems. When they solve one of these problems, they get to add a new block to the blockchain. As a reward for this work, they receive a certain number of bitcoins. This process is called mining, and it's how new bitcoins are created and introduced into circulation. Now, when Bitcoin was launched in 2009 by Satoshi Nakamoto, the reward for mining a block was 50 bitcoins. But Satoshi designed Bitcoin to have a fixed supply of 21 million coins. To ensure that new bitcoins wouldn't be created too quickly and to simulate scarcity, Satoshi implemented the halving mechanism. Here's how it works. Every 210,000 blocks, which takes approximately 4 years to mine, the reward that miners receive for adding a block to the blockchain is cut in half. This event is called the Bitcoin halving, or simply the halving. So the reward went from 50 bitcoins in 2009 to 25 bitcoins in 2012 to 12.5 in 2016, then 6.25 in 2020. The next halving, which is expected in 2024, will reduce the reward to 3.125 bitcoins per block. The idea behind halving is simple. By cutting the supply of new bitcoins entering the market, Bitcoin becomes more scarce over time. If demand stays the same or increases while supply slows down, basic economics suggests that the price should go up. This is why so many people pay close attention to each halving event. Historically, every halving has been followed by a major bull run. After the first halving in 2012, Bitcoin's price jumped from around $12 to over $1,000 within a year. The second halving in 2016 saw Bitcoin rise from about $650 to nearly $20,000 in late 2017. The third halving in 2020 led to the massive 2021 bull market, where Bitcoin reached an all-time high of nearly $69,000. While correlation doesn't always mean causation, many in the crypto world believe that the halving plays a major role in these price movements. But it's not just about the price. The halving also has a big impact on miners. When the block reward is cut in half, miners suddenly earn 50% less for the same amount of work. This can be especially painful for small or inefficient miners who rely on those rewards to cover electricity and hardware costs. If the price of Bitcoin doesn't rise enough to make up for the reduced reward, some miners may shut down their operations because it's no longer profitable. This can lead to a temporary drop in the network's hash rate, which is a measure of the total computing power being used to mine and process transactions. However, the Bitcoin network is designed to adjust. Every 2 weeks, it recalibrates the difficulty of mining to make sure that blocks are still added roughly every 10 minutes, regardless of how many miners are active. Over time, inefficient miners drop out and more efficient operations take their place. This is part of how the Bitcoin network evolves and maintains security in a decentralized way. In the long run, halving helps to ensure that Bitcoin remains scarce and continues to mimic precious commodities like gold, which are also difficult to mine and have a limited supply. Now, some people ask, what happens when all 21 million Bitcoins have been mined? Will miners just stop working? The answer is no. Once all the Bitcoins are in circulation, miners will no longer receive block rewards, but they will still earn money through transaction fees. Every time you send Bitcoin, you include a small fee to incentivize miners to include your transaction in the next block. As the network grows and more people use Bitcoin, these transaction fees are expected to provide enough incentive for miners to continue securing the network. There's also a lot of debate about whether halving is already priced in by the market. In other words, if everyone knows that halving is going to reduce the supply, shouldn't that already be reflected in the price before the event happens? Some analysts believe that the market is efficient and all known information is already factored into the price. Others argue that the halving sets off a psychological and economic chain reaction that leads to long-term price increases, even if people know it's coming. It's also worth noting that while past performance doesn't guarantee future results, the halvings have created predictable cycles in Bitcoin's price. These cycles tend to involve a lead-up period of accumulation before the halving, followed by a post-halving price surge, and eventually a sharp correction or bear market. Many long-term investors and traders build their strategies around these cycles. Of course, there are also risks. The next halving might not have the same effect if global economic conditions change, if governments implement stricter regulations, or if major technological shifts impact the crypto landscape. Bitcoin is still a relatively young asset, and the future is never certain. Still, halving remains one of the most unique and important features of Bitcoin. It combines technology, economics, and game theory in a way that no other financial system has done before. It's a self-regulating mechanism that gradually slows the creation of new coins and enforces scarcity without the need for any central authority. To sum it up, Bitcoin halving is a fundamental part of how Bitcoin works. It ensures that new supply decreases over time, which in theory makes Bitcoin more valuable as it becomes more scarce. It affects miners, it influences market sentiment, and historically, it has triggered massive bull runs. But it also introduces challenges, especially for miners who rely on block rewards to stay profitable. Whether you're a casual observer, a hardcore investor, or just crypto curious, understanding the halving is key to understanding Bitcoin itself. It's not just a technical event. It's an economic signal that echoes across the entire crypto market, and it reminds us that Bitcoin is more than just code. It's a carefully designed system that challenges the way we think about money. Thanks for watching. If you found this explanation helpful, consider subscribing for more deep dives into crypto, blockchain, and the future of finance.